questions? Just for a five-minute question. Thanks very much. Any time particularly that I should send you a quick note?
No, I should be there from like 9:30 on. Okay. So last day of class. No, you can hear me? No? It's on. It's the last day of class. You knew that already. Yeah. Might as well reinforce it. So the final exam is day after tomorrow, 1 o'clock. I haven't sent you the rooms yet, right? So I'll send it to you after class today. The review session is up. I put it up yesterday. I sent you the links, and you should be able to get to it from the webcast page. And thank you for sending me all your summaries. I got perhaps 220 by 7:30 this morning, which is when I had to leave to catch the train, and there were a few more that came in. But I think we have almost everybody. I think there might be a handful, maybe 8 or 10, which I don't have. So what you're going to see actually is the results that you sent in. So you know what I'm already saying, right? Don't blame me. If there's any screwy number there, it's all your fault. So I thought I'd pull together everything we've done in this class and do the last session in 2 parts. So first I'm going to do a very quick review of the entire class in about 35 minutes. I'm going to use a frame that you might or might not like, but I will essentially use it as a series of tests. So basically, let's see as we go through if the big lessons have stuck. So series of 10 basic lessons out of the class. And in the second half of the class, I'd like to take your numbers and show you what you found across the 220 companies for which you sent in buy, sell, hold, DCF, pricing. And I'll give you a contrast as to what you found relative to what prior classes have found going back 20 years. So you can get a sense of perspective on, hey, what percentage of buys in this class versus 2008 versus 2005 versus 2002. Along the way, I'll stop and talk about how recommendations have done over time. Obviously, it's too early for me to judge you because it's been only, 24 hours. You know? But if you wait 2-5 years, how are the undervalued done relative to the overvalued? Is there any value to what comes out of these valuations? So let's get the show on the road. When I started this class, there were 3 ways you could attach a number to an asset. The first is to do discounted cash flow valuation, where you project out the expected cash flows, you adjust for the risk and the discount rate, you come up with the present value and say, that's the value of my company. Intrinsic valuation. The second is pricing. We attach a number to your company based on how similar companies are being priced out there. And I hope by this point in the class, at least you're getting a sense of what the difference between the two is, especially when you start thinking about a company or an asset. And the third is contingent claim valuation or option valuation, where there are some companies where the discounted cash flow value understates the value of the company, and they argue there should be a premium added on. We talked about natural resource companies, biotechnology companies, where the optionality can add value. So what I'd like to do is go back to the very basics. If you look at intrinsic value, no matter how you dress it up, the value of a company or a business comes from 4 specific characteristics. The first is the cash flows you get from your existing assets, right? Which you can measure by looking at the last year's financials. You can look at the after-tax operating income, subtract out the reinvestment, you come up with the cash flow. So that reflects both how well you're running the existing assets, and if you're running them efficiently or not, that's where it's going to show up. So if you talk to me about a company that's badly managed and badly run, I should see it in those cash flows. The second is the growth rate and the value you get from growth, which is a function both of how much you grow and what excess returns you deliver while you grow. If there's something we've kind of talked about over and over in this class, growth by itself has no value if you earn your cost of capital. So it's growth with excess returns, and that depends on what kind of competitive advantages you have as a company and what your constraints on growth are. Maybe you're in a small business, you can't grow that fast. The discount rate is a weighted average, of course, of your cost of equity and cost of debt, but step back. It is the only place you have in a discounted cash flow valuation to reflect risk. You can't show risk in your cash flows. It's an expected cash flow. You can't show risk in the growth rate. It's an expected growth rate. The only place in a DCF to show risk is the discount rate. So you discount the cash flows back over the length of the growth period. You get a value for the operating assets. You add cash. You subtract out debt. If you have any cross holdings, you bring them in. If you have minority interests, you net them out. You come up with the value of equity for the firm. So that's intrinsic valuation. And if you step back, it's not particularly complicated. It's a fairly simple process, but there are all these little places where you can trip up. So I thought about ways in which I could present the kinds of sins you could commit in discounted cash flow valuation. And I drew on a book that I was supposed to read for college, but I skipped and read the Cliff's Notes instead. It's by this deeply disturbed Italian guy called Dante. And the book is called the Inferno. The reason I call him deeply disturbed is this book is entirely about visiting different layers of hell depending on the kind of sin you commit. Now, my wife's a Catholic. My kids are brought up Catholic. I'm I guess an honorary Catholic because I go to church every Sunday. And if you think about Dante, he takes every Catholic problem and takes it to the nth degree. So basically in Dante's world, depending on your sin, you go into harder and harder layers of hell until you reach those layers from which you can't come back, I guess. So I'm going to take you through valuation hell, starting with small sins, going to bigger sins, to the very bottom from which there's no redemption. So I'm going to start off by talking about what I call the base year fixation. We've all fallen for it. You know the base year fixation, when I sit down to value a company, what do? You grab the last annual report. You act like the world started in 2015. There's a lot of stuff before, but it's so much work to go pull up those 10Ks and annual reports. We're going to talk about the base year fixation, the kinds of mistakes that come out of it. Then we're going to talk about taxes. We talk about taxes, but we're incredibly inconsistent about the way we deal with taxes and cash flows and growth rates and discount rates. So I want to talk about tax problems. Third, I want to talk about lengthening growth periods. So easy to do on a spreadsheet, 3 to 5 to 10 years, and talk about how long growth usually lasts at companies. And follow it up with a very quick review of what's supposed to be in the discount rate, and more importantly, what's not supposed to be in the discount rate. The discount rate is not the receptacle for all your hopes and fears. Every time you feel a little uncomfortable, you can't go to the discount and say, I'm going to move it up a little and feel much better about it. So I'm going to talk about the limitations of what you can bring into discount rate. The fifth question I'm going to ask you is about growth. I'm going to come back and say, hey, that's nice that you're growing, but where are you paying for that growth? Reinvesting. In other words, I want to make sure your valuations are not Oompa Loompa valuations, where your factories are run by Oompa Loompas and therefore can produce as much as you want. We talk about debt ratios. All too often in DCFs, 90% of the DCFs I see out there, the debt ratio gets set up front, the cost of capital gets computed, and never changes over the period of the valuation. If you go back and look at all the DCFs we've done in this class, That's the exception rather than the rule. In most companies, the discount rate, the debt ratio, the cost of equity, the cost of debt should change. So I'm going to talk about debt ratios changing and how they can affect the cost of capital. And I'm going to come back and visit this big number that drives every DCF, the terminal value. Don't make it an ATM. Every time you feel your value is too low, you're tempted to go to that number and say, let me play with the growth rate. After you're done with the valuation, don't do a lot of garnishing, adding 20% for control, knocking 15% off for liquidity. We talked about how that can kind of put you back in the number you wanted to see. And then we'll talk about all the impediments in getting from the aggregate value of a business to the value per share of a company. Many of you wrestle with this in the context of valuing shares in your company. You got the value of equity, 2 classes of shares. What do I do now? You had equity options outstanding. What do I do now? So aggregate to equity value. And finally, I'm going to give you a bonus layer of hell. That's a layer from which there's no redemption. I'm going to call it the Wasserstein-Perella layer of hell. If you get there, don't come back. Okay? You're beyond redemption. So let's start this, and I'm going to make this a series of examples. Think of this as a review for the final exam, because obviously you don't have that much time to review for the final. Think of this as your quick review. So as we go through, try to answer these questions rather than let me come up with the answer. Okay? So let's assume you're valuing ExxonMobil in 2009, March, April of 2009. The revenues, operating income, capex, change in working capital, and free cash flow to the firm from 2008, I've pulled the numbers. Let's assume that I know what I'm doing with those cash flows, and that is actually the cash flow for 2008, a $54 billion free cash flow to the firm. You assume that the cost of capital is about 8%, not unreasonable for a mature company. It's pretty close to what you'd expect. And that you're going to use a growth rate of 2% forever, which in 2009 would have been a sustainable long-term growth rate. So I've got cash flows from last year. I've called this firm a mature firm. I've given it a growth rate of 2% forever and a cost of 8%. The market cap for the firm is about $373 billion. But if you took the numbers I've just given you, free cash flow to the firm last year, cost of capital and growth rate, and I've made the numbers nice round numbers, so you should be able to do it in your head. Roughly speaking, if you plug the numbers into a discounted cash flow model, what would you get as your estimated value for ExxonMobil as a company? What's in the numerator? $54 billion, right? Free cash flow, it's already after reinvestment. You divide by R minus G, 0.06. 54 divided by 0.06 is 900 billion. You either have the most incredible bargain on the face of the earth, or you've screwed up big time somewhere. So here's my question. I have only 3 numbers in my valuation. One of them has to be off, right? Is it the 8%, the 2%, or the 54 billion? And if you can identify the number that's off, tell me why it's off. Is it the 2%, you think? Yeah, maybe you could argue it's in a natural resource company. Maybe it should be 0. Maybe it should be -2. But you can already see that changing the growth rate is not going to dramatically affect my terminal value that much, because even if I make it 0, I still come up with a $700 billion value. So growth rate might not be it. Could it be the cost of capital? Maybe ExxonMobil should have a 15% cost of capital. Unlikely, right? If you think about the distribution of cost of capital for U.S. companies, 7.5% is the median, 11% is the 90th percentile. There's no way ExxonMobil is at the 99.99%. So it's not the growth rate, it's not the cost of capital, which leaves you with just the free cash flow. Why do you think the free cash flow is giving you such a strange answer? What's that? The question you should ask, and I should have filled in the detail, is what the price of oil was when I did this valuation and what the price of oil was during 2008. The average price of oil during 2008 was $80 a barrel. When I did this valuation, it was down to $45 a barrel. That's the base year fixation. The free cash flow from last year is right, given the oil price last year. But if I'm valuing ExxonMobil in March or April of 2009, I will have to correct that earnings for whatever the oil price is today. If you get a chance, go back and look at what I did with Royal Dutch, because I faced exactly this problem when I was valuing Royal Dutch this year. Is the oil price had changed? I had to fix that to make sure that I was, in fact, using a cash flow that is consistent with the oil price today. Because if I use the 2008 operating income, you know what I've effectively valued ExxonMobil as? I valued it based on an oil price of $80 a barrel. And the question I'm asking is ExxonMobil a bargain if oil prices go back to 80 from 45? Of course. I don't even need to do a DCF valuation to conclude that. So be careful about the base year fixation. It's so easy to get trapped in looking at one annual report and building off that. Now let's talk a little bit about taxes and value. Let's assume that you've been asked to value a company. I've given you the financials for the company. EBITDA minus DA, EBIT, interest expense, taxable income, taxes, and net income. I'm going to make this a very simple valuation. Let's assume that this is a mature company with a 0% growth rate forever. Whatever cash flow you get will be the cash flows in perpetuity. Can you estimate the free cash flow to the firm for this firm, given that income statement, given that it's a constant growth company? What's the definition of free cash flow to the firm? It's EBIT times 1 minus T minus net capex minus change in working capital. It's true I haven't given you capex and change in working capital. But why do you not need it in this case? Because you have no growth. If you have no growth, you have no reinvestment. If you have no reinvestment, those two. So your life just got a little simpler, right? If you compute EBIT times 1 minus T, you got the free cash flow to the firm. The EBIT is 100 million. So what the basic question I'm asking you is, what taxes should I be taking out of that EBIT to get to my free cash flow to the firm? Sounds like a slam dunk. The taxes are right there. 32. Can I take out 32 million from the 100, come up with the 68 million? Why not? Why shouldn't I use 68 million? The depreciation is a tax benefit anyway. So because I can't add back the depreciation because remember the capex will exactly offset it. When I said reinvestment is 0, I'm not saying capex is 0. I'm saying capex is equal to depreciation. So depreciation washes out. Why is my tax only 32 million? Because I have interest expenses, right? You're saying, so what? You get a tax benefit from interest expenses. You should not be including those tax benefits in your cash flows. Somebody remind me again why I shouldn't be including the interest expenses. And I am going to discount them back at a, which includes an after-tax cost of debt. The tax benefit is already in my discount rate. So what I need to do is ignore the taxes I see there and do what instead? What's my tax rate? It's 40%, 32 divided by 80. I have to act like I will be taxed on the 100 million. I know it's hypothetical. You will not pay 40 million in taxes, but you have to act like you have 40 million in taxes, which gives you a free cash flow to the firm of $60 million, 100 net of taxes. So remember that when we talk about unlevered cash flows, you've got to play a mind game of acting like, I have no debt. What would my taxes have been last year rather than take actual taxes paid? It's amazing how many inconsistencies you see with taxes creep into discounted cash flow valuations. But that's why you have to be careful about the tax you net out to get to the free cash flow. Michelle? That's actually a good question. Do I always use marginal tax rate? Somebody want to help me out on that question? When do I always use marginal tax rate? What part of the valuation? For the cost of debt, I always use marginal tax rate. You know why? Because interest saves me taxes at the margin. It's the last dollar of income that I protect on interest expenses. But when I compute after-tax operating income, this is the tax rate I pay on all of my income. So I cut myself some slack here. If you're Apple and you consistently pay only 20% off your, it's not even because you have interest expenses. You just pay 20% because your income is overseas, you don't bring it to the US. I will cut you some slack when I do your cash flows of using the effective tax rate for the near term, but eventually you're deferring taxes, I have to deal with that, right? I have to tell you that at this point in time, your tax rate will have to start moving towards a marginal tax rate. So the answer is with cost of debt, I always use a marginal tax rate. With operating income and cash flows, at least for short periods, you can end up using the effective tax rate to compute your cash flows.
You would even use it in your cost of debt calculation.
Exactly. And here's why, because let's take Apple, right? Apple pays 20% on its global income and taxes. When it borrowed $55 billion, guess where it parked all $55 billion of its debt? In the US, so it can get the 40% tax rate. Companies don't randomly spread their debt. They go to the high. So it's actually, they get the best of both worlds. They get the effective tax rate by taking advantage of the tax laws, but they also get the marginal tax benefit on the debt. It'd be crazy for Apple to borrow any money in Ireland, even though it has an Irish sub, because you don't get any, the tax benefits you get there are only 12% rather than 35 or 40%. Any questions about taxes? Now let's talk a little bit about growth. As you look back at your valuations, I kind of forced you into a 10-year growth period if you use any of my models. But that was really not true, because if you set your growth rate equal to your stable growth rate and nothing changed, I put in a 10-year window, but it's really not affecting your valuation. So your growth period can be 2 years, 3 years, 5 years, 8 years, 10 years, 20 years, 30 years, 50 years. In theory, there's no reason why it can't be any of those numbers. So the question of how long growth will last is really an empirical question. How long does growth last for a typical growth company? I don't know whether you remember this graph I showed probably a couple of hundred pages ago. But this was actually a study that looked at IPOs and compared the revenue growth at IPOs to the revenue growth of the sector that company was in. The year after the IPO has a revenue growth 15% higher than the sector. You're saying, that's why I bought the IPO. 2 years later, it's 7% higher than the sector. So how quickly it fades. 3 years later, it's 3% higher. By the 5th year, you cannot tell the difference between the star high growth company and the rest of the sector. That's across all IPOs. What does that tell me? Growth fades fast at most firms, no matter how promising they look. That doesn't mean there aren't exceptions. Of course, you have the Googles, the Facebooks, the Microsofts, which are the exceptions. And those companies must bring something special to the table. So when you sit down to value a company, there is no way around the fact that before you decide what growth period the company should have, you stop and ask the question, what's special about the company? What is it doing that's going to allow it to grow for longer than 5 or 6 years? That competitive advantage, barrier to entry. And if you can find something, there's nothing wrong with going with a 10-year growth period. But be cautious about pushing past 10 to 15, 20, 25, because now you're valuing your company to be a truly exceptional company. And that's problematic, because everything it does then can only be a negative surprise. Now I'm going to show you a cost of capital, a completely, totally screwed up cost of capital that I actually pulled off from an actual discounted cash flow valuation. And there are at least 6 mistakes in this one cost of capital. That's tough to do, to make 6 mistakes in one number. And I want you to tell me as I go through this process, even as I describe this, start ticking off, I wouldn't have done this, I wouldn't have done this, I wouldn't have done this. So the cost of capital of the company, I've changed the name of the company to Chippewa Technologies, a US technology firm with 20% of its revenues from Brazil, has been computed as follows. First, for the risk-free rate, the analyst replaced the current T-bond rate, which at that time was 3%, with an average T-bond rate for the last 25 years, because he said, rates are low, they're probably going to bounce back. So he replaced it with a normalized rate. For the beta, use the adjusted beta from Bloomberg. It is adjusted after all. Then for the equity risk premium, he used the database called Ibbotson. Now Duff & Phelps maintains it. For US stocks minus T-bonds, the arithmetic average of 5%. And then he added a small cap premium, because over that same period, small cap stocks earned about 3% more than large cap stock. You put those all together, his cost of equity was 14%. He went to the cost of debt. For the cost of debt, he started with the fact that the company was not rated and did not have bonds. So what he did was he computed a book interest rate, which is you divide interest expense by book value of debt. And he came up with the 3% cost of debt. He netted out a tax benefit using the effective tax rate, because that's what he'd use for his cash flows to get the tax benefit. And for the debt ratio, for the equity, he used market value of equity. For the debt, he said, you know what, I want to be conservative, and he started counting everything into debt, accounts payable, supply, credit, all liabilities other than equity into the debt number. Okay? So you ready? Let's go item by item. Start with the risk-free rate. So your job is to tell me, I'm the analyst, tell me what I did wrong. Why should I not normalize the risk-free rate? 30% of all DCFs that I see normalize risk-free rates now. Why shouldn't I normalize risk-free rates? I normalize earnings, I normalize margins, I normalize everything else on the face of the earth. Why shouldn't I normalize risk-free rates? Yes, Michelle. Well, But that's actually, if it corrects itself, I should normalize it.
And also normal is based on your age.
That's true, but that could be said about any other variable as well, right? So there are two. There's actually a final argument you can make, which will show beyond the shadow of a doubt you shouldn't be doing this. What happens if you use a 5% risk-free rate? Go ahead. So I should have a different normal then? But I'm using a normalized 10-year rate, so I'm consistent with my 10-year time horizon. Now we're getting closer. Let's say I use a 5% risk-free rate. What happens overall? Holding everything else constant, what have I done? I've pushed up my discount rate, right? I push up my discount rate, what do I do to my value? I push down my value, probably well below the price. So what have I told you? Shouldn't buy the stock, go put your money in something risk-free on which you can make 5%. Well, good luck with that. Because you just made up the 5%, there's nothing out there that's risk-free on which the reason risk-free rates cannot be normalized is there an actual opportunity cost. It's what I can invest in. I can bitch, I can moan as much as I want about how low the interest rates are right now. But guess what? That is what I'm going to be making on my money if I don't invest in stocks. That's why we don't normalize rates. And guess what? When risk-free rates change, it's not like the rest of the world stays still. The risk-free rates dropped after 2008 because we were in a crisis. But that same crisis did what? Pushed up equity risk premium. So you cannot be using a 5% premium going back in time when you in fact have a premium that reflects where you are in history. And if you're in a crisis, that premium is going to be much larger. And remember the other ammunition I gave you on historical risk premiums? They're backward-looking numbers. But statistically, they have a problem, right? You get a premium of 6% or 5% over the last 60 years. It comes with a standard error, which is often 2.5% to 3%, which means you're not even sure what the risk premium is historically. And if you think about that standard error on the small cap premium, it's actually about as large as the small cap premium. You cannot statistically reject the hypothesis that there is no small cap premium. So the risk-free rate, you shouldn't have normalized. For the risk premium, you should be using a forward-looking premium. And there's one other thing that I should be incorporating. 20% of their revenues come from Brazil. The fact that they're a U.S. company doesn't mean I can just use the U.S. risk premium. I should be incorporating the risk premium for Brazil into my calculations. What about beta? You know what I made you, forced you, held a gun to your head to do, which is I asked you to use a bottom-up beta, right? But you're going to have this fight a few months from now on a valuation. When somebody says, I was always taught to use regression betas, bottom-up, what's this bottom-up beta stuff? So tell me why a bottom-up beta is better than a regression beta. One is, it's what? It's the law of large numbers. You get a more precise estimate, it's a standard error. Second is, if your business has changed over the last 3, 4, 5 years, a regression beta is going to reflect what you used to be. A bottom-up beta reflects what you'd like to be. And third, with a bottom-up beta, you can value IPOs, you can value divisions, you can value private companies where you can't get a regression beta. So I'm going to replace the adjusted beta with the bottom-up beta. So 3 mistakes already in the cost of equity. Let's go to the cost of debt. The problem with using a book interest rate is it's not constrained. In fact, within this valuation, you have a problem. Do you see what the problem is? The risk-free rate that's being used is 5%, and you're telling me on a pre-tax basis you can borrow money at 3%. That's not going to fly, because the cost of debt is supposed to be a forward-looking cost of debt, not a backward-looking cost of debt. And that rate should always be higher than your risk-free rate. It should be the risk-free rate plus a spread. And if your defense is, I don't have a rating, not a big deal. You can estimate a rating and come up with a default spread. It's an estimate, but so is everything else in your valuation. Why do you resist it just on the cost of debt? And finally, on the debt ratio. He was trying to be conservative, right? That's why he wasn't piling in everything into debt. But is that conservative to keep throwing things into debt? What happens if you do that? Your debt ratio goes up. Your cost of capital actually declines. So here's what I did. I redid the numbers basically with what I think should have been used. I'd have used the actual T-bond rate. I'd have used a bottom-up beta. I'd have used an implied equity risk premium for the US, but adjusted that for the country risk in Brazil, I come up with a cost of equity of 15.68% instead of 14%, even though I don't have a small cap premium. For the cost of debt, I came up with a pre-tax cost of debt based on a synthetic rating. I switched to a marginal tax rate because the tax benefit is at the margin, interest rate, and my after-tax cost of debt is 5.4%. I switched the weights to be just market cap and interest-bearing debt, and what I get is my corrected cost of capital is 12.6%. So it's a process by which you essentially take apart the cost of capital to make sure it is capturing what you'd like it to. Now let's look at growth. A lot of valuations, managers supply you with estimates for the future. You can't fight it. That's the way it's done. I talked about this in the context of Tesla and Solar City, about how the cash flows came from outside. You can say, I don't like to do this, but the reality is management is an ego. They want you to use the numbers they've given you. All you can do then is to take those numbers and make sure they're internally consistent. You've got to put managers in the spot. So I'm going to try this out on you. I'm going to be a management team, and you're going to be my analyst, valuing my company. And I'm going to give you my projections as management for this company. And I want you to find the weakest links in my forecast. So I projected out revenue growth of 10%. Margins stay, increase with are constant. So my operating income increases proportionately. I've given you capex and depreciation. After all, I'm management. I know what I'm going to be investing, and the change in working capital every year. So there's my free cash flow to the firm. So you got these numbers in front of me. What are the things you're going to ask me? As you go through the questions, what are some of the questions you want to ask? First, let's start with the revenue growth. How do you decide whether a revenue growth is a reasonable number, unreasonable number? What are you going to look at? Perhaps my market share right now relative to the total market, how big the market is, to make sure that 10% doesn't give me a market share of 112%, right? So let's say I pass the test. 10% is okay. I'm a small enough company in a big enough market. The margins stay constant, and I say, okay, I can pull that off. Then you're going to be looking at whether I'm reinvesting enough to sustain my own growth rate. And how do you decide whether I'm reinvesting enough? What are you going to look at? You're going to look at my reinvestment rate, right? What's my reinvestment rate? In fact, it's constant across time. It's about 33, so if you look at my free cash flow to the firm, it's about 20% of my after-tax operating income. Just add up the net capex and change in working capital. It's 20% each year. So my reinvestment rate is 20%. My growth rate is 10%. You're one question away from making me as a manager defend my own numbers. So what's the implied return on capital I'm assuming the company has? 10% growth rate, 20% reinvestment rate means that my return on capital is roughly 50%, right? Don't even bring that up. Ask me what my historical return on capital is. Now I can't evade and jump around. Say, well, I've made about 12% a year for the last decade. Now you got me, right? Then you say, well, what's changing? If you made 12% as your return on capital for the last decade, how come you're assuming a 50% return on capital for the next 5 years? You know what my first defense is going to be? I didn't assume a return on capital. I just made up cash flows and a growth rate. But every time you see a DCF, whether the analyst wants to or not, implied in the forecast is an assumption about return on capital. And it's your job and my job to probe that number and say, is that a number that you can live with? And the answer is no. Then you either need to reinvest more or lower your growth rate, right? So basically, you can't have your cake and eat it too. So when you think about growth, think about reinvestment. Let's talk about debt ratios. Say I come to you with a firm, 90% equity, 10% debt, Hormel Foods. Cost of equity, cost of debt, I come up with a cost of capital of 6.8%. That's what I used in my valuation. Let's assume that I tell you the target debt ratio for this firm is 30%. I just want to get a sense of direction from you. How would I compute the cost of capital of Hormel Foods if I change the debt ratio from 10 to 30%? Can I just change the weights, 0.3 and 0.7, and recompute the cost of capital? Why not? In fact, I triple my debt, I definitely will have to pay more, so my cost of debt changes. What else will change? My cost of equity will change as well, right? Because the cost of equity I have with 10% debt. So here's what I need to do. I need to first unlever, and I know this sounds like tedious crap that you've gone through over and over and over again, but you got to keep doing it at least till this class ends, then you can do whatever you want, right? So here's what you need to do. You need to take your beta at a 10% debt ratio, unlever it to get to a debt, to a beta, the unlevered beta, then re-lever it using a 30% debt ratio. And I promise you the beta you get will be higher than at 10%. If it's not, go back and check your math. Okay? Your beta will go up, your cost of equity will go up, your cost of debt will go up. Your cost of capital might therefore go up or down. In this case, let's say it goes to 6.96%. The trade-off works in your favor. That's my final question. You got two costs of capital now, one with the existing debt ratio, one with the target debt ratio. Which one should you use in valuing this company? The actual or the target? You're a passive investor, which one should you use? You know what I mean by passive investor? You own shares, you don't run the company. Who runs the company? The existing guys do. And what are they telling you about debt? They don't like to borrow money. Remember, tomorrow it's not your company. You can't go in and change it. It drives me crazy when analysts who are valuing companies for passive investors change debt ratios to target, acting like it's their company. It's not your company. You don't set the debt ratio. As a passive investor, I think you should actually stick with the 10%, because the target is something you made up. Unless the managers explicitly say, we are going to triple our debt, just stay with the 10%, value the company the 10%. Would your answer be different if we were acquiring the company? Yes, because then you get to set the debt ratio. Then you can use a target debt ratio and an acquisition valuation. Let's talk about terminal value. There are three ways you can estimate a terminal value. One of them should never be used, so let's make sure that we get that out of the way. You can estimate a terminal value using a stable growth model, the perpetual growth model. And remember, in that model, your growth rate can be 1, 2, but it's capped, the stable growth model. The second is you can use a multiple of EBITDA or EBIT or book value to get the terminal value. The third is you can estimate a liquidation value. We've done this before, but there's no harm in doing it one final time. What's the one way you can never estimate terminal value? Don't use a multiple. And be ready to argue why, because again, you're going to see this practice around you all the time. So start thinking about the difference between value and price and figure out a way that you can explain it to somebody quickly so that they can understand what's wrong with using a pricing to come up with the biggest number in an intrinsic valuation, because then you've created this hybrid, which is neither fish nor fowl. Right? It's not an intrinsic value, it's not a pricing. I'm not even sure what it is. Right? Liquidation value is fine, because that's a cash flow, you can use it. So now let's assume that you decide to apply this. You're valuing a business. The business expects to generate $120 million in after-tax earnings next year and to continue generating $120 million every year in perpetuity. Let's say the cost of equity is 10%, composed of a 3% risk-free rate and a 7%. What's the value of this business? Numbers are there. You don't need a calculator. $120 million is your cash flow forever. It's a perpetuity. 10% is your cost of capital. 120 divided by 0.1 is 1.2 billion. So the value of this business is 1.2 billion. Well, what if I told you could grow 2% a year? What's the value of this business now? Seems like a slam dunk, right? 120 divided by 0.1 minus 0.02, that's like 1.5 billion. This is so easy. Man, made it 4%, it'll become 2 billion. Made it 6%, it'll be 3 billion. So easy to create value out of nothing. But when I increase the growth rate to 2%, it's true the denominator will now become R minus G, right? But what's going to happen to my numerator? Growth is not free. So I have to net out from the numerator what I have to reinvest. So you know what I need to tell you to be able to do this? I need to give you a return on capital for this company. And let's say I told you the return on capital was 10%. You know what's going to happen? Let's work through the numbers. With a 10% return on capital, to grow 2% a year, I need to reinvest 2 divided by 10, 20% every year. 20% of 120 is 24 million. Your numerator will now become 96 billion, 120 minus 24. Your denominator will be 0.08. 96 divided by 0.08 is 1.2 billion. Nothing happened. But why did nothing happen? Because my return on capital was equal to my cost of capital. Do not, I'll hit you 3 times at least on the final exam on this question, just to make sure you get it, right? 2 out of 3 is not good enough. I want you to get it right every single time. You have a terminal value calculation. When there's growth, you have to reinvest enough to sustain that growth. And if that reinvestment is coming at a return on capital equal to the cost of capital, growth doesn't matter anymore. And if just to do this, take this example, try an 8% return on capital, try a 12% return on capital, just so you can get comfortable with how terminal value changes as growth changes. So now let's say you finished a discounted cash flow valuation. You come up with a value of 100 million. I want somebody to keep a running tab as we're going through, because I'm going to throw items at you. And with each item, here's what I want you to tell me. Whether you'd add that item, so 100 million is your base, you come up with that. Add that item, subtract that item, or ignore that item. 3 choices. And with each one, if you give me an answer, I'd like you to tell me why. So I've got a value, discounting free cash flow to the firm at the cost of capital of 100 million. I have a cash balance of 15 million. Add, subtract, or ignore. Come on, this is the easy one. Add, why? Because that's what we've always done. Come on, now, by now you should be able to give me something more than that. Why am I adding the 15 million? Because the free cash flow to the firm does not include the income from cash. I haven't included it yet. That's why I add the 15. That's why we don't add it to a dividend discount model. Because the dividend discount model comes out of all net income, which includes the income from cash. We add cash because we haven't counted it yet. So add. So that was easy. Somebody keeping a tab here, 100 plus 15, 115. Debt outstanding of 20 million. Add, subtract, or ignore. To get to the value of equity, you're going to subtract out the 20 million, right? Why? Because the debt was already in the 100 million. It's the value of the business, so I'm going to subtract out the 20 million. So that brings me back down to 95 million. Now let's see how much you remember your cross holdings. I have a 5% holding in another company. The book value of this holding is 5 million, but the market value of equity of the entire company is 200 million. So what do I do with this? First, add, subtract, or ignore. Why add? Because if it's a minority holding, the income from that holding is not part of my EBIT and my free cash flow to the firm. I haven't counted it yet, so I need to add it. But what do I add? I add 10 million, which is 5% of the 200 million, because I'm trying to estimate the intrinsic value of the company, not the book value. But let's say I told you that the company has a minority interest of 10 million in the balance sheet. Add, subtract, or ignore. When does minority interest show up? It's when you consolidate it, right? When do you consolidate? When you own 60% of a company, which means your cash flows reflect the value of the entire subsidiary. The minority interest is the accountant's attempt to estimate how much of the subsidiary doesn't belong to you. You'd like to know the market value of the minority interest, but if you don't, you're going to subtract out the 10 million. So let's see where we are. 100 plus 15 minus 20 plus 10 minus 10. We're back at 95. That becomes the value of equity in the company. And of course, if I threw in options, you got to deal with that as well. So basically, think about all the items and think about, don't make it mechanical, because there are too many mechanical pieces to memorize. Stop and reason your way to, should I be adding or subtracting? Because the answer really will lie in what have you done. You did the DCF. You know what went into the cash flows. You know what did not go into the cash flows. It's your job to mop up. So that's a value of equity. What if I told you that there is now a chance that this company could have to pay out 100 million in a lawsuit? How would you incorporate that in your valuation? First, what if there's a 100% chance you will lose this lawsuit? What's the value of your equity? It was 95 before, right? There's a 100% chance of losing the lawsuit. It means you're going to lose another 100 million. Your equity just went to below zero. If there's a 50% chance of losing the lawsuit, 50% of 100 million is 50 million. Subtracting from 95 million will give you a 45 million. So if there's a lawsuit, the only way to incorporate is to bring in the expectation of losing that lawsuit and what you'll have to pay out. Let's talk about equity value. So you come up with a $95 million equity value, right? To get from equity value, in this case, let's change the number to 200 million. if there are 10 million shares outstanding in the company, the value per share obviously would be 200 divided by 10 is $20. But what if I told you there were 2 million employee options outstanding with a strike price equal to the stock price and 5 years left to expiration? The value per share was $20 per share before I threw this information in. My only question is, will my value per share be lower after you've learned this or higher after you learn this? Or will it depend? It's an at-the-money option, right? If you view an at-the-money option as worth nothing, then your value per share will be unaffected. That's what we do in the treasury stock approach. If I use the treasury stock approach here, and if you don't remember what it is, I add the proceeds to the numerator and divide by the total number of shares, my value per share is not changed. But you can already see that that can't be right. Because an at-the-money option with 5 years left to expiration is not worth nothing. You've given away a chunk of equity in the company. To do this right, you have to value the 2 million options, subtract them from the 200 million, and then divide by what? By the 10 million shares. So don't double count, right? So if you subtract out the value of the equity, you can't double count. And the final layer of hell was from the second week, right? When you're discounting cash flows at a discount rate, first and foremost, make sure you're being consistent. Consistent in what sense? First, if your cash flows are after debt payments, say cash flows to equity, your discount rate has to be a cost of equity. If they're before debt payments, they have to be a cost of capital. And when it comes to coming up with the discount rate should match the risk of the cash flows being discounted, not the discount rate of the entity looking at the cash flows. We did this again when we did acquisition valuation. This is why when you value a target company, the discount rate used to value the target company should reflect the risk of the target company, not the risk of the acquiring company. And from this layer of hell, there's no redemption. Because if you mismatch cash flows and discount rates, the mistake you're going to make is going to be so enormous. I mean, I gave you the example, First Boston on this deal, a 40% difference in values, that you can't fix it. Right? So it's a pity because you've done all the work right till the very last stage and then you mismatched. Okay, so make sure that you're matching up your cash flows to your discount rates. So let's look at your numbers. Okay? As I said, 220 of you turned in evaluation. The first question I asked you is, what cash flow did you discount? It was a slam dunk. And I expected this. About 90% of you use free cash flow to the firm. 5% of you use dividend discount models, and almost every single company on which the dividend discount model was used was a financial service company, right? And again, we're falling back on that, but be careful because as we talked about when I did the Deutsche valuation, that trust in dividends comes with a cost. And that cost might be getting too high for us to face even in about 5% of free cash flow equity. The reason it makes sense is with free cash flow, you should get the same answer with free cash flow to the firm and free cash flow to equity, but free cash flow to the firm, you reserve so much more freedom to change the debt ratios over time that I think it makes complete sense that most of you use free cash flow to the firm. I've never restricted anybody from valuing a company that other people are valuing in the stock, and you can see why when you look at this page. 3 companies were valued by at least 6 people apiece. Facebook, Under Armour, and Tesla. First, the prices are all supposed to be on the same day, but I guess you were a little confused about the day, so I'll cut you some slack on that. So it's almost, it's a little bit over the, but roughly, so the price for Facebook is about $120 per share. But you can see the DCF values range from 75 to 177. And the pricing is actually, also varies. There were 3 buys and 3 sells. Under Armour, again, the prices vary. Unless the price jumped dramatically, that 27.61 looks like it's at least 2 weeks old. And the reason I bring that up is if you brought that up to 32.36, the recommendation might have changed. So I don't know how much that played a role in this process. Again, 3 buys, 3 sells. And Tesla, there were 2 buys, 3 sells, and 1 hold. Am I surprised? Not in the least. Think about these 3 companies, right? All 3 of these companies, especially Facebook and Tesla. Remember we said narrative drives numbers? The story you can tell for Tesla can range anywhere from it's an electric car company which produces luxury automobiles to it's a clean energy company that produces automobiles, other batteries, etc., etc. The value reflects it. All I'm saying is we think of valuation as a model. You put in the numbers, you're going to get a value. You can already see that you all pretty... I'll wager that at least 4 or 5 of these valuations use my FCFF simple Ginzu model. And all that's different is your story gave you different answers. Of course, half the people here are going to be right and half are going to be wrong. We don't know yet, right? Ex ante, that's exactly why we do valuation, is it allows us to reflect our stories in our numbers. Here's what you found. So basically I compared your DCF value to the price and estimated how undervalued or overvalued you found shares to be. There was one company that was actually undervalued by more than 50%. I'll show you what the company was. And at least 18 or 19 companies were overvalued by more than 100%. Your average company was overvalued by about 37%. The median was about 12%. So more of you found your companies to be overvalued than undervalued. And on average, if you ask me to give it, by roughly 10 to 15%. The average is a little skewed by the outliers. The median is more reflective. Okay. Is that always happened? No. This number has ranged anywhere from minus 15% to plus 25%, depending on the year in which the valuation was done. But in this particular class, you are more likely to find companies to be overvalued than undervalued. Now comes the list. These were your most undervalued stocks. Notice how I keep emphasizing your most undervalued stocks, right? So this is Kojima Corporation was the most undervalued. That was a stock that was undervalued by 51%. So these are all undervalued. So that's the percentage by which they were undervalued. And I did list out the buy. You say, why do you need to list out the recommendation? There have been cases where an undervalued stock, you get a sell recommendation because the pricing might have given you a different answer, right? But at least in this case, all were buys. Don't ignore the caps. Those are not my doing. Some of you were screaming your buy at me. Some of you were whispering your buy. So I'm not sure what to read into the caps, other than the fact that there were some caps in there. Yeah. These are your most overvalued stocks. Tower Insurance was the most overvalued, because your value was 15 cents. The discounted cash flow value was $2.50. And at the other extreme, you have quite a few. TripAdvisor, lot of tech companies. TripAdvisor, Salesforce, Zillow, JCPenney, dead company walking, etc. You can go down the list. Right? So the most overvalued stocks. At the start of this class, I might have mentioned it, but if I did not, I'll mention it now. Every semester, I buy one stock. Not from this list. Maybe I should change, but from this one. Right? You think, how do I pick this? I'm going to let anybody whose company is on this list tell me in the next 48 hours whether they're putting their actual money behind this company, because if you're not, I'm not. So that's my first test. And that knocks off about 12 out of the 15. The excuse is I don't have the money now, I'll do it later, etc., etc. No hedging. If you're buying, I'll be buying. So if there's more than one, then I'll go look at your DCFs and decide which one I have a little more faith in. And I won't tell you, so you don't have to worry. Just send me your recommendation. So if you're on that list of undervalued, do tell me whether you're buying, because that feeds into my choice. And here's why I buy. For the last, this is my 31st year teaching this class, my 53rd semester. And I've kept track of these undervalued and overvalued stocks at the end of every semester. And I usually track the returns they make over long periods, because there's no point tracking them over a day or 6 months, because the nature of intrinsic valuation is you have to give the market time to correct its mistakes. So these are 5-year returns, annualized returns, for the spring 95, 97, spring 99, spring 2000. So I'll be updating and bringing it up to spring 2011 next year. But those are the blue are the returns on the buy recommendations that come out of the stock. The red is the S&P 500. The ugly green, yellow, orange, whatever that is the sell. So generally speaking, the buys outperform the market, the sells underperform the market. Now don't get too excited, because I'll give you some added information here. On average, you are right? But there's a lot of noise. About 60% of buy recommendations beat the market. Not 100%, but about 45% of sell recommendations also beat the market. So there's lots of noise, which means I can't just take the most undervalued, the most overvalued, do crazy things. The excess returns on buy recommendations, small cap and emerging market companies is higher than the returns on large cap companies. For better or worse, there seems to be more value there. The payoffs are extremely skewed. What I mean by that is those excess returns you're seeing on the previous page come from 1 or 2 big winners each period. Which means if I'm picking and pick 6 out of the 15, and if I leave out the big winner, I'm not going to see these returns. And that's actually not uncommon. Many investment strategies that beat the market get almost all of their returns from 2 or 3 or 5 out of the 20 that you bought. Okay? Which is one reason when you adopt these strategies, you have to stick with all of the stocks, because if you start pruning the stocks you don't like, you could very well be cutting off those stocks that provide you with the skewed returns. And stocks that are undervalued in both a DCF and a pricing basis do better than stocks that are undervalued just on a DCF basis. And that's why when I talked about value and price, I said don't make this an either-or proposition. Nothing stops you from valuing a stock and pricing a stock and asking that it be undervalued on both, because the pricing gives you short-term gains and the intrinsic valuation might give you the long-term gains. So that's the intrinsic value part. Let's talk about pricing. 4-step process, right? Define the multiple. Just because you say PE and I say PE, we might not mean the same thing. So go back and make sure it's internally consistent. Numerator is an equity value, denominator is an equity value, numerator is an enterprise value, denominator is be an enterprise value as well. Describe the multiple. Do the histogram. The data is there. Might as well look at the entire data rather than have rules of thumb. Like 6 times EBITDA is cheap. Drive what you do. Analyze the multiple. By now you know what to do. If I give you an equity multiple, you're going to go back to a stable growth dividend discount model. Don't make your algebra complicated. And do the algebra and tell me what drives price earnings, price to book. And if I give you an enterprise value multiple, go back to a firm valuation model. Free cash flow to the firm divided by cost of capital minus growth. Do the algebra. You're going to always be able to identify the variables that drive the multiple. And only then should you apply the multiple. So if you look at the drivers of multiples, and we talked about this as we went through each multiple, there are variables that drive that multiple. PE, it's growth, payout, and risk, or cost of equity. With price to book, it's growth, payout, cost of equity, and return on equity. With enterprise value to sales, it's cost of capital, reinvestment rate, growth rate, and margins. So every multiple has variables that drive it, and every multiple has a companion variable. That one variable you need to control for. PE is growth, price to book, it's return equity. Any revenue multiple, it's margin. Identify that companion variable. That is the key to doing pricing right, is to think about all those pieces that have to fall into place. Okay? So here's what you used. 30% used revenue multiples, either out of desperation, because all you had negative earnings and you had no choice, or because you just like revenues, you trusted them more. About 26% used EV to EBITDA, 10% price to book, mostly financial service companies again, 22 price earnings. So you can see the spread, mostly enterprise value multiples, just as you saw free cash flow to the firm overwhelming free cash flow to equity. Okay. And what I did then was I took your DCF value for your stock, and this is why I asked you to pick one pricing for your stock. And I compared your DCF value for your stock to your pricing for your stock, just to see whether your DCF value is higher. Probably no surprises here. Across your 220 companies, your DCF value was slightly lower than your pricing by about 4%. The median was off by about 8%. So your pricing was a little higher than your DCF, which you should expect, because earlier on I showed you that the DCFs, you came up with the conclusion that only 32% of your stocks were undervalued. You came up with more overvalued stocks than undervalued. The very nature of pricing is you're going to push towards 50%. And in fact, if you look at the 75th percentile, it was about 114%. So most of your pricing was a little higher than in DCF. Not all, but for most of you. And so here are your most underpriced stocks on a relative basis. Again, all I did was I took the price and I compared it to your relative valuation, your pricing, and I compared the percentage differences. Actually, I should take out one of the checks because I think that's just a double. It's showing up twice because I probably got the email twice. Right? But those are your most undervalued, and here are your most overvalued. Here you'll notice actually that the mix of recommendations is actually different, because many of you, if you went to your DCF, even though it looked undervalued on a pricing basis, you stuck with your DCF. And similarly, when you look at the overvalue, there are a few buys that creep in there because your DCF kind of gave you an answer saying go buy the stock. So pricing can give you different signals than the valuation. There are only 12 of you that were able to use an option pricing model. It's not your fault because, as I said, the constraints you need for an option pricing model to kick in. And the payoff to using an option pricing model is immense. In the companies where you could use an option pricing model, you got almost 118% premium. These are natural resource companies, distressed equity companies, 118% premium over your DCF value. That's why we like real options. It allows us to add that premium on. A very quick review of what we did in the last session, right? We talked about value enhancement. We talked about how to increase the value of a firm. And I said, and I emphasized upon that to change the value of the firm, you got to go to one of those 4 places. You have to increase cash flows from existing assets by managing them better. Increase the value that you get from growth by either reinvesting more if your return on capital is higher than your cost of capital, or reinvesting less if your return on capital is less. Maybe changing your cost of capital by changing your debt ratio, changing the discretionary nature of your products, changing your fixed costs, or lengthening your growth period by building your competitive advantages. Everything you do in restructuring has to show up somewhere in a valuation. Okay? And we talked about EVA, CFROI. The one thing that I did not get a chance to mention in the last class is one of the problems with these metrics that consulting firms come up with is compensation is often tied to these metrics. So in the 1990s, when EVA became this hot new approach in corporate finance, people started tying how much managers were paid to EVA. Horrible mistake, because then game playing begins. In fact, I have a paper on all the perverse ways you can increase your EVA while destroying firm value. Don't use this as a manual. This is really a cautionary note of, here are some, and I'll give you some examples. EVA measures the difference between return on capital and cost of capital multiplied by capital invested, right? So basically, it's that spread over your cost of capital times capital invested. Is it possible for me to, basically, the return on capital is based on operating income right now. If I go for higher operating income right now and give up growth in the future, which I can do, right? I mean, I might be trading off. I'll get that high EVA, get compensated based on the high EVA, and you'll be left holding the bag because I didn't reinvest for the future. It's the first way. I can make myself better off while making the company worse off. The second is, with EVA, and this is a very tricky process, because the cost of capital is sticky, it takes a long time for people to realize you moved into riskier and riskier businesses. What you will often see managers do is shift into riskier and riskier businesses, and while the cost of capital stays stuck, they will look like they're making more than the cost of capital because you're not adjusting quickly enough. That's a risk trade-off. And finally, when companies adopted EVA, they found a sudden jump in the use of leasing at companies. You know why? Because leasing was not capitalized. It didn't show up as part of capital invested. It allowed them to report these very high returns on invested capital and look like they were earning these huge excess returns when in fact they were not. So I'm not saying that this is always going to happen, but any time you tie compensation to a metric, you should expect to see some kind of game playing, and you have to be ready for it. So now you have your value for your company, you have your price. Forget about what I'll do with those numbers. I want you to think about what you will do with the numbers. Okay? So at this stage, here are the ways in which you might end up thinking about it. First is you can look and say, I'm not sure yet. And that's natural. You don't feel confident enough in your own valuation to act. Don't push it. Don't say, if I don't act, it's bad. No, you've got to kind of come to that confidence yourself. That's fine. No. Maybe some of you have done this process, after this process, are convinced that this is a game you can't win at. And that's, again, perfectly healthy. Let it go. Okay? If you don't enjoy the process of investing in valuation, and don't think about, am I enjoying it right now? Of course you're not. But step back and think about, do I enjoy the process of connecting stories to numbers, making these judgments? Then don't do it. Life's too short. There are so many other things you can fill your life with. Just put your money in index funds, and move on. Right? And third, remember that you don't have to be right on every one of your valuations. You don't even have to be right on 70% of your valuations. If you're right in 52, 53, you're basically going to make money on your portfolio. This is not being don't judge yourself on an individual investment going right or wrong, because you're going to be wrong a lot of the time. Okay? So here are your recommendations. So what I've done actually is compared from spring 99 to fall 2016, the buys, the sells, and the holds. You guys had a lot of holds, the highest number of holds ever. What a bunch of chicken, but almost 30 holds. That was in terms of percentage, the highest percentage ever. Maybe your valuations were just on the dot. In fact, at least 3 people emailed me over the weekend saying, I have a problem. I've just redone my DCF value, and it's come exactly equal to the price. What do I do now? I said, wait a day. It'll take care of itself, right? The price will move. This is not a permanent, this is not nirvana. It's just a moment in time. It too shall pass. But you, in terms of percentage of buys, you were a little better than the last semester. Was actually the fall 2015 was the lowest percentage of buys I've ever had. Even counting spring of 2008 had been the previous lowest. So this is a percentage of the buy to sell ratio. So spring of 2008, those guys were prescient. That's just before the crash, right? So fall of 2015, I was worried that you were predicting a crash, but it turned out you were wrong, so thank God for that. But you're not that much more optimistic still, so that's still a pretty low percentage, and you can see the numbers kind of bounce around over time. So let's close the process, right? We've talked about all these different ways of approaching valuation. Discounted cash flow valuation, your pricing, you have a contingent claim valuation. You have the tools in your arsenal. And you'll have to decide when you get to work which of those tools you're going to extract to put a number on an asset. Now, which one you will use will depend first on the kind of asset that you're valuing. I sent you 2 weeks ago the pricing of the week. I talked about pricing gold. You cannot value gold. Gold does not have cash flows. You cannot value Bitcoin. You can only price gold and price Bitcoin. There are some assets that you can just price. You can only price a Mickey Mantle rookie card. You can only price a Picasso. So if the asset does not have any cash flows, you have to price it. And if it's a truly unique asset, then it's very difficult to price it. And that's what makes painting so difficult to price, right? And that's why you end up paying these experts 15, 20% of the price of the painting just to attach a number to it. So which approach you use will depend on the asset you're valuing, and it'll also depend upon you. There is no one approach that's right for all of us. It'll depend on first your time horizon. So think about it. I'm not going to ask you what your time horizon is because that's your decision, your choice. If your time horizon is short, you should be pricing things, not valuing them. So you have 6-month, 9-month, 1-year time horizons. If you have 5, 10-year time horizons, then you have a lot more potential to use intrinsic valuation. It depends on why you're doing the valuation. Are you doing it for a transaction right now, in which case you should really be pricing it, or you're doing it to hold as a business for the long term? That's going to affect which approach you use. And finally, it depends on what you think about markets. Do you think markets make mistakes that they correct over time, in which case intrinsic valuation works for you? Or do you think markets are right on average but are wrong on individual assets, in which case pricing works for you? So look inward, because what I think about these is what I think about them. They've led me to where I am. You need to work this through for yourself. Even if you're never going to work in finance, if you're going to invest your own money, you need to be clear about what your views are on each of these before you make your choices. So I'll leave you with that exit question that I entered the class with, which, if I asked you to pick a valuation approach, would you go with intrinsic valuation, pricing, or have you reached a point where you say, you know what, markets are on average more efficient than not. And as I said, there's no right answer here, but this is where I want you to take, what I want you to take out of the class is at least a sense of, if you had to put a number on an asset, which of these approaches do you feel most comfortable with? And as I said, there's no right answer. It really depends on your perspective on markets, your time horizon, and why you're doing this valuation. I know when I started the class, I asked this question, how many of you are storytellers and how many are number crunchers? And along these 15 weeks, you've discovered your strong side and your weak side. I would encourage you, now that you've turned in this DCF to me, especially if you haven't made your story explicit to me in your valuation, to take a look at your own DCF and try to extract the story you told about the company. I mean, I would encourage you to find somebody at Starbucks, somebody you don't know, harass them. Can I tell you a story about a company? Don't get arrested by doing something incredibly stupid, no? But see if you can explain your valuation to somebody who's not a finance person, not a technical person, in ways that they can understand exactly why you like this company or not like this company. So I think, to me, that's what I hope you start building on, is connecting stories to numbers. Because I think you will find that if you can do this, if you're a storyteller, that you'll find that if you can work with the numbers, you get more discipline in this process. You're less likely to be carried away. You'll also become a pain in the neck in your corporate strategy classes, because you will now ask questions about stories, because there's a lot of storytelling, a lot of cases, and sometimes somebody's got to stop and say, that's nice, but. And I think that makes strategy much more powerful, much stronger if you can ask those questions. If you're a natural number cruncher, I think that as you start attaching stories to numbers, you will start to get more confidence in your own valuations. That's what I needed to do. For the first 7 or 8 years when I taught this class, I would value companies. I could not act on those valuations. Mechanically, I could see exactly where it's going. I had to start telling stories about companies that I bought before I could actually act on my valuations. So I'd encourage you to start thinking about those stories. So I'm going to close with some advice. I'm not a great advice giver, but might as well hit you with the advice as you go. The more things change in this business, the more they stay the same. We keep reinventing the wheel. Value's always been driven by cash flows, growth, and risk. That was true in the 1400s, the 1600s, the 1800s. It's always been the case. All we've done in the last 70 years is put this framework together that brings them together. The fundamentals never change. So when somebody says there's been a paradigm shift, one of the fundamentals, it doesn't matter anymore, they're lying. They always come back. Second, focus on the big picture. It's so easy to get lost in the details. Especially in today's world, we have models which have 100 line items, 10 years of data. It's so easy to get lost in the details. And if I was harsh on some of you when you turned in your DCFs with 300 line items in the middle of the semester saying, I have no idea what you're trying to tell me, it's because when you have 300 line items, you have no idea what you're trying to tell me. That's a reality. Nobody can do that. So step back and look at the big picture. Draw pictures for yourself of what those numbers are, the big numbers that are driving the valuation. There's a lot of storytelling in this process. Right? It's good to tell stories, but also connect those stories to always look at the broader example. So somebody can give you an example of an investment they made 10 years ago that paid off. That's nice, but take what they did and see if you can generalize it. Most of the time, a story is just a story. They're like my mother-in-law. Right? She tells stories. And the stories she generalizes, all kinds of things. They almost never work. It's amusing to listen to the stories, but I'm not going to do what she asked me to do based on those stories. Second to last thing I want to tell you, keep your perspective. It's only a valuation. It's only money. You say, what else is there? You have a spiritual problem. Talk to your priest, your rabbi. I remember about 10 years ago, at the end of one of these classes, second year MBA was graduating. This was in the spring. Comes to me. She was a history major from Yale who came back from an MBA. And usually if you're a history major from Yale who comes back for an MBA, you take the strategic MBA route. You know what that is? You pick only classes with the word strategic in its name. And you can get through 2 years of an MBA program without ever seeing a number. I've always wanted to sit in on that strategic accounting class. I know how you balance sheets without numbers, but no, you do Harvard case studies. Basically, you go through 2 years of Harvard case studies. Everything is strategic. And she ended up in this class, and it's not a strategic valuation class, right? You actually have to work with numbers. She turned out to be pretty good at it. At the end of the semester, she comes up to me and she says, I never thought this would happen, but I have a job as a sell-side equity research analyst. I said, my condolences. No, I said, my congratulations. You know? And she said, I'm really scared. I said, what are you so scared about? She said, what if I make a mistake? I said, be glad you're not a brain surgeon. You make a mistake, somebody dies on the table. You make a mistake, what's the worst that's going to happen? Somebody gets a little richer, somebody else gets a little poorer, right? Think like a Marxist. You move some wealth around, the world hasn't ended, move on. What I'm saying is, it's Saturday night at 11 o'clock, 7 months from now. You're at work in this heated argument about whether you should use the adjusted beta from Bloomberg or a bottom-up beta. My advice is just give in. Let the guy use an adjusted beta. What's the worst that's going to happen? Somebody gets a little richer, somebody else gets a little poorer. There's nothing in valuation worth losing sleep over, other than the final exam. Now, once you get that over, then you don't lie awake saying, oh my God, I used the adjusted beta instead of the bottom-up beta. Let it go. Nobody's going to die. And finally, if you're given a choice between understanding everything there is to understand about valuation and being lucky, which one should you pick? Don't even think for a second. Just pick being lucky. I shouldn't be saying this, but I'm going to say it anyway. This is a business where the dominant paradigm is luck. You know what I mean by the dominant paradigm? It's what separates success from failure. Everything else is a side game. And I'll tell you a story from my mother-in-law to kind of bring this home. My mother-in-law became an avid investor in the 1990s, which to me should have been a sign that the market was topping off. Kind of missed that sign. Mother-in-law in the market now, get out of the market now, right? And she came to visit us in early 2000. And she would drive us crazy. She would turn on one of these CNBC. She'd watch it all day, make it a spectator sport. Every time one of the stocks would go in the ticker, go, Cisco, go, and the stock would go up. It made it clear. And she was convinced that she was the competitive advantage that Cisco had over the previous decade. It's her cheering that did it for them. And all day long, all she would talk about what was in her portfolio, what was out of her portfolio, what she wished was in, and what she wished was out. And all day long, I had to act like I was listening, because that's what son-in-laws do. And then she let it slip that she owned Qualcomm, one of the great stocks of '99, up 600%. I couldn't stop myself. So I asked her, Judy, how do you pick Qualcomm? I knew the minute I asked this question I shouldn't have, because she told me. She told me she picked Qualcomm because it owned MCI. I said, that's not Qualcomm, that's WorldCom. She says, Qualcomm, WorldCom, what's the difference? I said, if you really meant to buy the company that owned MCI, you'd have lost 30%. Instead, you buy some other company that rhymes with it, and you make a 600% return. I was afraid to ask her after that why she owned Cisco, afraid the answer might be I really like the vegetable oil. Or Saturday Night Live. Who knows what drove that particular decision? But I'll confess that after she left, I did try her strategy. I'd pick a stock in the news, pick one that rhymes with it. You know what, if I'd made a lot of money, forget about this intrinsic cash flow stuff. I'd be the rhyming stock strategy. So my best wish, my parting wish for you is that you get lucky. If you get lucky, you can do really crappy stuff and get away with it. So be superstitious. If you find yourself buying the same grande cappuccino at the same Starbucks because it looks like your stocks go up when you do that, don't mess with it. Just go back to the Starbucks, even if you have to go 2,000 miles to get there, because it's not worth messing with luck. Okay? So I will see you on Friday. One more reminder, because the final exam is so compressed, you have only 1 day to do your CFE. You're saying, what's a CFE? Well, come on. It's like, this is what you have to do to see your grade. That's the only reason I care. Because if you don't do your CFE, I can predict almost precisely what's going to happen, which is you're going to do your final exam, I'm going to grade it, you're going to go check your grade, you can't see your grade, and then the rest is, of course, almost predestined. You're going to email me saying, I can't see my grade, can you tell me what my grade is? Since I don't want to deal with it, please do your CFE. I'll send you the link after class today. because by then it should be up, I don't know, 4 o'clock or so. Make sure you get it done. Not tomorrow, I think, is the only day you can get it done. And on Friday at 1 o'clock, I will see you at the final exam.
So I never found the time to go and talk to you about the square and so on. I would really love to do it next week after the exam. That's fine. I just have like really important question now. Well, two. What happens if I get a negative number of my price of the stock? Shall I just put like 0?
To be negative number for the value.
For the value. For 0 on the price. Yeah. Okay. So it doesn't. I cannot say like -2, even though it's not possible. Yeah.
Limited liability.
It can be like telling you how much background.
To go below 0,
Okay. And then this is for the second exam that I also never found the time. So there is only one thing that I have wrong here, and I get it. I messed up with the cash flow, with the reinvestment, but I was doing correct the sales to capital. The only thing is that I was doing capital to sales, not sales to capital. So then I multiplied, I didn't divide. But it shouldn't come like a mathematical problem.
I'll give you 120 back.
Okay. Okay. Should I make you?
Yeah, wait. One very last question probably should have. In terms of the operation growth, around investment capital because you may evaluate, let's say, how 5 years has growth, 5 years. I only use it at the terminal value.
See, that works when your margins are stable, right? So if you have stable margins all the way through, you can use it all the way through. It will work, as you say.
Okay.
But if your margins are changing, it won't work. And the terminal value margins can never change. But once you get to stable growth, your margins are fixed forever. That's why you always work in terminal value, but only sometimes when you have it.
Okay. So it depends on the case you use it.
So if your margins change, don't do it.
Okay. Thank you very much.
I just want to say thanks very much for a great class. Really had a good time. Thanks so much. Appreciate it.
We're in China or
Definitely, yeah. Yeah, thank you. Well, it's going to be you will be completing the class. Basically, it will be an IT on the class, and then you take the final. So initially, when you check your grade, because I turn the grades on Monday, because you won't be able to do it before I turn the grade. So initially, when you check your grade, it's and then you have to take the final, and then I turn the grade check. So I won't be here probably, but let you know. I keep the schools open Monday to Wednesday. So if it's Monday or Tuesday, let me know because what time you're coming. I'll be here, but Wednesday, then I'll have to tell you. So it's, email me the time you want to take it. Fine, thank you.
Some companies are not discussed how we're doing. So anyway,
I'll check to see if I'm coming. Good luck, take care.
one are you buying?
The rates. I
Oh,
think
the-
that would be the only. I'm the only one doing rates for the system.
It'll be interesting to see how REITs react to higher interest rates. That will be the big.
Yeah, so I've been digging a lot in the C to a price to CFE equation. I'll probably follow up with that. But well, luckily, surprisingly, like 506, like the solution all indicates that it's undervalued, and here is like I don't know, like very like 150 higher than right. But it's very interesting. It's entertaining. Yeah, thank you so much.
You're welcome. Do you think of returning to journalism?